Are you a business owner looking to optimize your investments? Your business is making money and you're paying yourself, but there's still money inside the company. Should you open a pension plan or take the money out and invest as an individual or invest as a company? How can you take money out of your company effectively? What investments or pension plans or strategies provide the best returns? How can you optimize the Belgian pension and investing products such as IPT, IP, VAPZ, PLCI, POZ, CPTI, DBI, RDT funds, because obviously all of those exist in both French and Dutch. And what are the tax implications of all these options? And how do these taxes impact your investment performance? That is what we explore in this incredible episode with Tim Nijsmans. Tim is a fee-only financial advisor specializing in index investing. He is a former asset manager at the private bank Dierickx Leys and a former fund manager of the DBI fund of Dierickx Leys aimed at business owners and companies. You can find out more about him on his website at vermogengids.be. He is also a Fire Belgium consultant, and you can book a call with him on firebelgium.com/one-on-one. In this episode, we discuss 9 different strategies to invest your money as a company owner. Tim then presents a very specific case and shows us the huge differences in results depending on the chosen strategy that you implement. And those differences are huge. The best strategy gives almost double the performance compared to some other ones. So this obviously can make a huge difference in your personal finance. If you're a business owner and looking to grow your wealth, then this episode is for you. Hi, my name is Sebastian Aguilar. I am the founder of Fire Belgium, a community of more than 8,500 people today. And I've been investing in the stock market since 2012 and teaching how to invest evidence-based index fund for the long term since 2015. I have a portfolio of more than 1 million euros built only from saving from my employment all the way until I start working in 2018 and index investing. Nothing else. Simple and effective. Today, I share my knowledge and explore new knowledge through these podcasts to help you take control of your finances, invest better so that you can live more and give more. Welcome to the Fire Belgium Show. I think before we start, I'd like to just, for those of you who are not familiar with index investing and how we operate, Tim and I, and how we recommend most people invest, because it's basically proven to be the right way to invest, is first of all, we're speaking about investing in the stock markets, not real estate directly, no commodities, no crypto, all of that. That's not exactly what we're talking about today. It's really stock market investing, optimized for long-term performance, optimized for taxes, optimized also for having to do very little in terms of management. So it's a passive approach, also called hangmat belegging in Dutch, investing from your hammock or from your couch. It's an investment strategy that has been sort of discovered in the 1950s already, early discussions around the way to invest and how it was difficult to beat the market as an active investor. And later, with more academic research and development, it's become something that was actually feasible for us individual investors in 1975 with the launch of the first index ETF accessible to retail investors. And it's basically arriving in Belgium now in the past 20 years or so, with the establishment of some index investment funds, some index investment financial advisors, but also with the rise of index ETFs and the access that we have to brokers. Now, for those of you who really don't know what an index fund is, it's basically a way to invest in the stock market that doesn't try to pick winning stocks and buy them at the right time, sell at the right time, try to make a profit. It doesn't rely on an investment manager doing that either. But in a way, it is also very similar to a bank fund that you would buy at the bank, although those are usually actively managed by an active manager or fund manager. They cost a bit more. The majority are not able to beat the benchmark, so the stock market itself. And multiple research keeps showing that it basically is an inefficient way of investing, but that is what is sold by the banks. And private banks, common banks and financial advisors all are selling mostly that kind of approach. and trying to get the highest fee possible out of it, commission that are basically slowing down the growth of your investments. But index investing doesn't mean that you have to become a super active manager. It doesn't mean that you have to track your portfolio on a regular basis or like every day and try to trade and this and that. No, it is a bit like buying and investing through a bank fund because you just put money in and you don't do anything. But the beauty of it is that it's far more effective. You don't pay the bank. You actually benefit from the overall growth of the stock market in general. Index investing is extremely interesting in Belgium, especially for individuals, and that's like 80% of you already doing it. But for the other 20%, why this is interesting is also because it is mostly tax-free or very, very low taxes. So high performance, low fees, low taxes. It beats all investment funds by active managers sold by banks and private banks in Belgium on a consistent basis long term. And it doesn't require much, just a bit of knowledge and the right strategy to put it in place. And that's really all you need. And that's what Tim and I teach and help people with. And then today, specifically, we're going to speak about how we do this for business owners, so as business owners, and how you can benefit from this and how you can optimize your investment strategies as business owners or as a future business owners. All right. And so for that, we have Tim today with us. Tim is one of the only fee-only financial advisors in Belgium, at least the only one I know. And how that works is that basically most financial advisors and financial managers will take your assets and put them under management. It's basically say, I'll take care of your money. You just pay me a percentage fee. And the percentage fee is basically a massive drag on your investments. Tim doesn't do that. Tim actually provides independent advice, irrespective of how much you're investing and without actually, I believe so, taking your assets under his management. He teaches you how to do it. He optimizes it for you, and you pay a very fixed low fee that over the long term basically is extremely cheap compared to any other investment solution that we have out there, and provides better returns because it's based on academic research and without having, the massive inefficiencies of all those big financial institutions. Tim teaches that in a simple and effective way. I do that too, by the way. I do that too. But I'm not an independent financial advisor. I'm an indicator. So I teach, and Tim also goes a bit further, but we have a similar role in a sense, maybe more hands-on with Tim, one-on-one. With me is more like group type work. But anyway, so that's what we do. Tim, if you would like to add something to this.
Well, it was a good introduction. Maybe I can add some specifics. Why I'm maybe interesting for this meeting is that I work with clients who usually, not always, but a lot of them also have a business. And I get asked the question, Tim, what do we do with the money that's in our business, is tied up in there? What's the best way to put that to work? And that makes me interested in looking for an answer with that. And maybe as a side note, for a year or two, I was the manager of a DBI fund, an RDT fund in French, a DBI fund at the private bank where I worked before. So for a year or two, I was the manager of fiscal optimized product for business owners. So I have a little bit of a management perspective on that. I was not the fiscal person on it, but I was the manager of the fund in this sense. And together with my, let's say, new colleague, Tim de Prijker, who has done lots of the work, we've decided to look into the companies, how companies can optimize their money in regard to investments. And that's what this podcast webinar is about.
Okay, then let's start. Then, Tim, what are the different options for business owners to invest in the stock market?
Yeah, there are a lot of different options, and maybe I should start with a little introduction that usually what happens is that people go to their accountant. If they have money on the balance sheet, the trusted advisor is the accountant, and that's good. It's the role of the accountant to work with you as the business owner to look at solutions. But what I've noticed, and that's not a critique, in the contrary, accountants are of course focused on the numbers, the hard numbers, and they don't want to go in the predictions or in the uncertainty that investments and the stock market always is. In the short run, there's always uncertainty. And we've noticed as advisors that accountants usually prefer things that, let's say, can be calculated exactly. And that's, of course, not really what we do as advisors. We compare the different options, but with assumptions that are not really can be stated with certainty. but we can help people look at it. And remember, if you're at your accountant, you are the client. You are the client. And hopefully with the information that we provide today, you can have a spirited discussion with your accountant. But let's maybe start with the first one. I'll share my screen here so we can have some backup. Let's start.
Just maybe for those who are listening to the audio version of this podcast, the screen is just here to help us guide the conversation, but we will describe things, in the best way we can verbally, so that there's no need really to look at the screen.
Yeah, you're not missing anything if you're just listening to it. We will describe everything. Maybe also a little message from Tim and me. So Tim and Tim, if you have feedback on this, if you have some knowledge to add, we want to help building this information for company owners, index investors, and company owners. So all the feedback is welcome at info@vermogensgids.be. So we can add on this, and we'll give back to the community, of course, when we get we hope we get a lot of feedback on this. Good. So the first way to invest in your company, if you have a company, of course, is just to open an account with the company and invest in the stock market. You can use that and use the company money to invest in the stock market. You can buy ETFs, you can buy stocks, you can buy bonds, you can buy everything. But there has been a fiscal change. There has been a fiscal change in 2018 that the capital gains are no longer exempt. So from now on, you usually pay a 20 or 25% corporate tax on the capital gains, on the profit you make on your investments. And to make matters worse, you can't deduct the losses. So you pay on the profit, but you can't deduct the losses of certain investments. So that's a big drawback to invest directly in the stock market. A fund or an index fund or an ETF, the winners and the losers are matched with each other usually, so that's less of a problem. But if you go for individual stocks, it's a very big drawback that you are taxed on the profit and you can't deduct the losses. So that's not a good thing. There's only a few escape routes that we're going to discover today. One is if you have a lot of money, but I think most of you don't have 2.5 million euros to invest in a single company or have 10% of a stock market company, usually. So that's probably out of the question. And then we go to the DBE. That's a DBE question. And look out, don't invest more than 50% of your equity in certain investments, because then you might lose a lower corporate income rate. So always look with your accountant to how much you're investing if you're making use of a lower corporate income tax in Belgium. So investing directly in the stock market with your money as a company owner, we would say, no, that's not the best idea. So that's the first option we have looked at. And we have said, no, let's skip that one. We saw with a lot of your answers in the poll that a lot of you invest. Not a lot of you invest in the DBE. Sorry, it's the IPT. The DBE RDT fund, I've said I've managed one. It's something that the banks and maybe also the government came up with after 2018. After the tax was the capital gains tax was added, there was a new product, a DBE fund, an investment fund where you can invest in equity, and its capital gains are exempt. That sounds good, and that sounds good. Capital gains are exempt, but it's an investment fund from the banks. They have to follow a few rules. And those rules are not very interesting for you as an investor. For example, they have to distribute every year 90% of the gains and the dividends. So there's no accumulation or capitalization of the profits. That's a drag. You have to pay 30% on the distributions of those dividends. So that's also a drag on the yield. And if the fund doesn't quite follow the DBE rules, there's also a part that is not tax exempt. And I don't have to explain this to the most of you, I think, especially not to Sébastien. The management fees are rather high. 1%, 1.7%, or around that number is usually the fee they withhold every year. So every year the bank gets 1.7% of your investments for managing the portfolio. But that, of course, comes out of your return. And that's the problem we have as index investors with active management. They have a lot of fees, high fees, and that is a problem to get investments that cover those fees. It's very difficult. DBE funds are actively managed, so there's no index investing DBE fund that I know of already. If you know one, let me know. And if you do invest in a DBE fund, it's still in the company. If you eventually sell your DBE fund, it's not that it's in your personal portfolio then. So you still have to get it out of the company with the taxation problems that you have with that.
Do you know why this exists then, if it doesn't look so interesting? Are there situations where this is interesting?
Well, my colleague Tim Nijsmans says if Belgians here tax optimized or tax friendly, our brains goes off. He says we don't think anymore. So if the bank says, well, dear company owner, instead of paying 25% on the capital gains, why not buy a fund from us? You have no capital gains tax. So they sell it with the capital gains good, like the exemption about that. But if you look at the whole picture, it's not very interesting.
So this is sort of it's an improvement on the situation that we were talking about before, where the company owner would invest directly with the company
individual stocks
market.
Then this is a step. This is a step
it's
up,
slightly forward, but it still forces the whole investment to actively manage funds, and it remains within the company. And we are forced to pay dividend distribution taxes. And what is this limitation on participation is to be above 2.5 million euros within the fund?
Well, if they want to keep the DBE status or investment fund criteria, they have to invest a lot in one company. They have to have big participations in the companies. Maybe some funds get exempt of that because we have to check this. Like in the whole of the presentation, if people who are listening or looking at us, if they have more information about this, let us know, then we can better this presentation.
Yeah, we will continue improving this and also find.
And maybe a little political side note on this. The DBE funds were on the discussions, the budget discussions in the Belgian government. It was almost cancelled, this DBE exemption. And then you have, if you've bought it, you just have an investment fund. So you have the worst of two worlds. You don't have individual or ETFs. You have an active fund, an expensive active fund, and no capital gains exemption. So if you know it's already been in the budget talks of the Belgian government, how sure can you be that this system remains?
Okay, not good.
So the DBE fund, in our opinion, is not a very good solution to the problem. Luckily, I only saw 4% of you that own a DBE fund. Let's say, don't make it 5%. Another solution that the insurance companies gave, and so you have the banking solutions, and then you have the insurance companies that come with solutions. And they say, okay, why not invest in a Taxes or branch C's fund? And that's a Luxembourg insurance contract. And it's a capitalization fund. You have to have a larger amount to start with this kind of investment. And they can be invested in fixed income or high-risk assets. The DBE can only be equities. For the last one, only equities. Here we can go if you want to, but if you have a long time horizon, like you said, why have bonds is maybe not really necessary. And you have no taxation, but on the end. And I hear sometimes, well, you don't have tax until you sell, so you don't have to sell. But that's, I think it's a strange argument. Yeah, it's a strange argument. You only have a tax if you sell. Yeah, once in a while you want to use your money, I think. It's not, we don't invest in perpetuity, I think. So I think it's not a very good argument to say there's no tax until you sell, but you don't have to sell.
That's like all capital gain taxes, no? They
Yeah.
apply when we sell. Mm-hmm.
Yeah. In these taxes or branch C's funds, it's usually it's mostly actively managed funds. I haven't seen any index funds here. If people see them, let me know. And of course, if the management fees of the BE funds are high, I've noticed, I've also worked for a year in the banking insurance company, so in the investment branch of a banking insurance company. And if I think the active funds are expensive, the branch 23 or branch 6 funds are really expensive. So it's usually the same problem. And again, like with the other options, if you sell this, it remains in the company. It's not in your personal investments. It's still in the company. You still have to get it out. Something that my colleague said, okay, does it match this webinar, this podcast? Because it's not with company money that you invest in a VAPZ or in a PLCI. It's tied to your role in the company, of course, but it's private. You can tax deduct it in your personal taxation, but what's the downside? It's not scalable. It's attached to your wages, and of course, your wages are also taxed on another level. So if you increase your wages, you increase your taxation on the other side. You have no tax upfront, but you have 22.17% taxation at the payout at 67. If you're 67 years old, you have to pay a lot of, and we see that a lot in these schemes of the government, that you get a tax break in the beginning and you pay tax at the end to reimburse the government. So they're nudging you in a certain direction, but actually in the end they just want back a lot of their tax profits. When you get a tax advantage, you pay it back at the end, or a part of it. If you go VAPZ, it's usually a branch 21 or a TAC 21, and those are low returns. They're fixed returns, but low returns. With a maximum, we have found somewhere there's a 25% branch 23 position in the VAPZ, but it's still very low. And we haven't found yet a VAPZ with index investing possibilities. Again, if you found a VAPZ with index investing possibilities, let us know. We want to help our clients. If there are some, let us know. My colleague, Tim Nijsmans, who's done a lot of the calculation of this example, says if your time horizon is shorter than 10 years, maybe VAPZ is a viable option. If you have a shorter time horizon than 10 years, till you go on your pension, then maybe it's a viable option. It's an option, of course, but it's not optimal, we think. Good. Then maybe interesting to look at a few possibilities through the lens of a case study. If we use an example and then look at the different options that we have calculated, maybe that clarifies things for the audience. We have a case study with a Belgian company, usually management company, and that has excess liquidities. So there's money in the company, money that's not used operationally. That's why usually management companies are the ones that do this, but of course there are also other companies that do it. It's available at year end, and it can be used for investment purposes for the long run. So this is the way to look at this case study. The question we're asking ourselves is, what's the most effective way to invest this money? We work with rough estimates. If you want to fine-tune it, you can always contact us. We want to stimulate your debate with your accountant. Again, your accountant is your helper. He's very good at what he does, but he's usually very conservative, very about the numbers that are predictable, and he's not really into taking in account the index investing possibilities of equities. Usually they say, okay, 0%, to be extreme. They usually don't even think about the plus value of index investing. And that's a bit too conservative in our opinion.
So here, maybe to clarify for everyone who's also listening to this, so far what we've covered with Tim are ways of investing that don't seem too good, essentially, right? We've looked at the way to invest directly as a company into stocks or investment funds, which is not very interesting because of the tax implications. Then we looked at the DBI and RDT funds, which are also not exactly good. We discussed TAC 6 and Branche 6 as well as VAPZ and PLCI, right? Basically, what you've done, Tim, I think so far is saying these are existing options, but in your opinion, Tim, and I agree with you, these are not interesting options. Now, what we're going to do next is we're going to look at options that are more interesting, right? So for those of you who are listening or watching so far and saying, well, everything seems to be so bad, why are we even bothering? No, there are options that are actually quite good, and we're going to look at them in the next few minutes. But Tim proposes that we use a practical case study, so a specific example of someone with a company that has excess cash liquidities at the end of a specific year. And in this case, we say 50,000 euros available, and that is willing to invest for the long term, right? And now going forward, what we're going to do is look at different options that are better than those that we discussed so far and compare them with rough estimates, calculations that Tim and his team have done, so that then we can have a better idea of what's possible and what looks better than the rest.
And we've made some calculations. We don't claim that the calculations are perfect. We don't claim that at all. We want to make them better. Give us feedback. We are asking for it. You can go to info@vermogensgids.be as a mail address, and I can give it to my colleague to refine our models. Good. I'm not going to, for the people at home and at the podcast and for the people here, we're not going to go about all the assumptions and the numbers. If you're listening to this and you want to know the exact numbers, you can look at YouTube and see the slide with the numbers. But the most important thing are the end numbers, I think, and the big decisions that you have to make if you want to pursue an investment with your company. So let's start with the first option, investing in an IPT or EIP. I saw that a lot of you do it already, so that's interesting to know. And you probably already know that that's tied to salary requirements. An IPT is tied to certain salary requirements. Then you can start investing in the EPT system, and you can use a back service if you want to. And let's say we use a back service of 50,000 euros in this case. EPT investments are taxed upfront at 4.4% and at the end at 16% if you settle it at 67. If you go earlier, like say 60, the taxation is significantly higher. And you can get it out, but it's taxed a lot higher. Usually, and it's a good system, the system is not that bad, but what could be better is, and there's a solution to this, what we come to later, that it's invested in an actively managed fund. Could be TAC 21, branch 21, or TAC 23, branch 23. That's equity usually, with a higher return. But for example, we used the example of a Baloise Carmignac Investissement. It's 2.7% total expense ratio yearly. So you heard me say the DBI fund was 1.7%. Here we see the Baloise is 2.7% yearly costs. So the yearly management fee. And it gave in the last 10 years a 5.8%. And I think, Sebastian, I think we can say that in index investment funds in equity did a lot better than 5.8%.
Yes.
Can be combined EPT with income insurance. And as a disclaimer, maybe a disclaimer for this whole presentation is that we of course do not know how the Belgian fiscal regime will evolve in the next 25 years. What is the taxation at retirement? But of course, that's for every case. So we are explaining with the rules we know of, the rules that are currently applicable. So EPT is the first scenario that we use. Let's go to our second, and at the end we'll do the numbers, and the numbers you will find interesting, I think. The second scenario is you pay yourself a dividend. you pay yourself a dividend, you get your money out of the company, and you do a private investment in index funds. Of course, you get a 30% tax hit. If you're not, I saw in the chat that people were talking about the VAPZ. But we're going to assume most of you are just taxed at 30% withholding tax. And for example, we use the Globetrotter in my book, the Hangmatbelegger. We used the Spider MSCI All Country World as a worldwide equity ETF. And we're investing the net amount. So after the 30%, we invested in the stock market. So of course, it's a big hit. You have 30% tax, it's a big hit, but then you are in a pretty much, we think, optimal investment, very low cost, equity, full equity, capitalization. So for the moment, that is a pretty good individual investment. Again, there could be after a new government other fiscal regimes, but for the moment, let's go with the current regime that we know of. So that was the second scenario. The dividend pay.
Just maybe for context, here you're suggesting a specific ETF. Obviously, it is not personal financial advice, but it's certainly an ETF that the entire index investing community agrees is optimal for long-term investing, broad diversification. It's actually part of the top 5, even the top 3 index funds that Fire Belgium doesn't directly recommend, but certainly finds super interesting. And we have a podcast that it's all about this, coming soon for those who are here live today, but that was released recently for those of you who are watching the replay, where we discuss all of these ETFs and we specifically address this one because it certainly is one of the best. Yes.
Yeah. And of course, there are others. Very true, Sebastian. There are other ETFs also. And not necessarily worse. Good. The third scenario that we're calculating, and we'll keep you in suspense about the numbers. That is the liquidation reserve. I also saw in the poll that it was together with the IPT and the VAPZ. The liquidation reserve was also very popular because, and that's, I think accountants like that, they can say, okay, your dividend withholding tax goes from 30% to 15%. 10% in the beginning, 5% at the end. But you have to wait 6 years. And some people might say 6 years. I've heard 5 years. But if you look at how it works, you have to wait for the next annual meeting after the 5 years are done. So in practice, if you take all the time you need, it's 6 years. So that's a long time to not be invested. So what we did was we made, let's say, an assumption that you, even if it's not the best option, for the 6 years we will invest within the company with the money that's blocked, that's been put aside for this liquidation reserve. So in our calculations, we say, okay, we go from 30% to 15% taxation, and in 6 years, the first 6 years, we invest within the company with the negative tax that we explained in the first part of this webinar and podcast. But afterwards, we will pay out the dividend, the liquidation reserve, after 6 years, and then invest privately again. And we will look at the numbers, keeping you in suspense. What is the best scheme we think? The last scheme, the fourth scheme we're discussing, and then we will go to the numbers, is a similar scenario to the IPT, but it's the index IPT. So what do we mean by that? Instead of the IPT, in most cases, you have an actively managed fund in your IPT or EIP, but you could also have an index fund, an ETF inside your IPT. There are a few players who started with this. We are still, Tim de Prijker and I are still looking at the different options, but there are some options now. We're exploring the companies that are doing this, and we see that they have, of course, they have a packaging fee. Nobody works for nothing. It's completely logical that there is a packaging fee for the IPT, but it's a much lower than the actively managed fund. So the fees are a lot lower than the actively managed EPT, so the classical EPT. Okay, we have a fifth one, the liquidation reserve with a loan. So this is what some people would call a bit sportsmanlike. It is more dynamic planning. But it's not, and we checked these schemes, these 5 schemes then. We checked these 5 schemes with an accountant. So, of course, it could still be that there are some things that could be better managed. Again, if you have feedback, let us know. But if you want to combine the liquidation reserve with a loan to you personally, from the company to you, you can start investing 6 years earlier. So you have the 50,000 euros. You go to the liquidation. You use the 50,000 to set aside a liquidation reserve. But instead of investing it yourself in the company, you make a written agreement, not rekening courant like they say in Dutch, but a written loan agreement. Let's say 4% or something like that. You have to have a real interest rate. You pay your real interest rate to your company. The company is taxed on the interest from you. So that's a negative, but a little negative. But you can invest 6 years longer in your personal account in, for example, an ETF. And that makes a lot of difference. And you might guess, because of the tone of my voice and the explanation, now we can go, I think, to the numbers. And we started with 50,000 euros. Remember it? 50,000 euros, 25 years time horizon. Okay. The first scheme we said was the classic EPT. The classic EPT was 50,000 euros, and you get, after 25 years, you get 866 euros. So 125,000. That was a classical EPT, not the index EPT. The second scheme was a traditional dividend. That's an even better result. Some people might think, is a classical EPT worse than simply giving myself a dividend? That's counterintuitive. Most of you are thinking, why do I do an EPT if I can just give myself a dividend and invest? Well, we can discuss. If you want to have more information, you can ask us. But if we use the assumptions that we clarified, 25 years, 30%, of course, withholding tax, and then investing in a worldwide index equity fund, then you get 188,000 euros instead of the 125 at the classical EPT.
And so this is explained by the fact that we take the money out of the company paying the dividend tax, and we invest it as individual in basically an optimal ETF with no tax advantage scheme, but basically it's so much more lower cost that the performance on its own covers for the 30% tax that we pay.
The compounding
and way more.
Yeah, the compounding effect is so strong in 25 years that it blows away the 30% tax on the dividend. That's negative, but the compounding interest of the ETF in equities is so strong that it goes beyond, and it's not an extreme assumption that we're making. We've also made assumptions with lower yields, with lower interest, with lower rates for the ETF. Even then, this remains intact. Not the numbers change, of course, but the ranking doesn't change. Then a third one that's better than the dividend is the liquidation reserve. But remember, the liquidation reserve with 6 years investment in the company and then 19 years investment outside the company in your personal portfolio in index investing. That's important. You have to do that also, and not just put it on a bank account and in a savings account. It's index investing after the money is paid out.
And during those 6 years, it's invested within the company through something like an EPT, or? No,
through something like just an ETF, but then taxed at 25% after 6 years. So it's a painful tax at 25% after 6 years, but still, again, the compounding effect afterwards, and after the 19 years compounding effect, 6 years also, but with with a 25% tax, too bad of that tax, of course, but it's still, it's 201,000 euros. So let's repeat. Classical EPT 125,000, dividend 188,000, liquidation reserve 201,000 euros is for the moment the three schemes. The fourth scheme is the index EPT. So not the classic EPT, but the EPT where the active managed funds are changed or just at the start used an ETF or an index fund instead of an actively managed fund, with packaging costs included. So we included the packaging costs that we know now. We have two companies that use it. We used their packaging costs. Then we come at 216,000 euros. So better again than the liquidation reserve at 201, better than the dividend at 188, and better than the classic IPT at 125. Look at the difference between the classic EPT and the index EPT. It's a huge difference. That's the difference between active investing with higher costs and index investing with lower costs. That's a big difference. But the number one scheme with our assumptions, and again, if you don't agree with us, let us know, give your arguments why we should look at it differently, is the combination of the liquidation reserve with the loan to the company owner. So a formal loan, but we use, of course, the money from the loan to invest immediately. Immediately, we invest in the index fund or the ETF, and we use it for an investment of 25 years. And we have a little less. We have not 30% withholding tax, but 15% withholding tax. We pay a little bit on the 4%. We pay a little bit on the 4% interest rate that we pay the company. But you have 25 years of compounding of the index fund, and that gives 228,000 euros, better than the 216,000 euros of the index EPT, better than the liquidation reserve without the loan of 201,000 euros, better than the dividend 188,000 euros, and better than the classic EPT at 125,000 euros. So a lot of numbers, but I hope the principles are clear, and we have tested it for 25 years. Of course, there are shorter periods that can change a little bit of this ranking, but I hope this is food for thought.
Yeah, so this is really useful, Tim. Thank you so much, because obviously you've run actual numbers with a set of assumptions that we can't go through in details because it's just a lot of numbers. It's going to be tiring, but some of these assumptions could change. Some of these assumptions, for example, one of them is the interest rate, right, for the loan between yourself and the company, and this will depend on the general interest rate environment, which changes over time. And in the past couple of years, it's gone up quite a lot. So this was certainly even more powerful a few years ago. Making a loan like this, which I think is called a bullet loan, it would be even more powerful at that point because the interest rate would be much lower. And when we get taxed on the interest, then it's an even smaller one. Whereas in higher interest rates environment, then maybe that option costs a little bit more, but it's still only for those first 5 to 6 years during the loan, right? Because the remainder is just invested very optimally. But I can imagine that if we get to interest rates of like 10% or whatever,
that might change the
ranking. Yeah. But it's true that today, I think someone was saying in the chat, we're at like 5.6% or something. So it's a bit higher than what's in the current model. But again, the results are probably very similar to what we have here. Because
if we use 5.6, it's not going to change the calculation that much to change the ranking.
Yeah, it might be closer to index EPT maybe, but
it might be close to index EPT, but I don't think it will switch.
No. Yeah, those two are very, very amazing options, basically, right? Yeah. My understanding is when you do this through liquidation reserve plus a loan, is basically doing it as a DIY investor, right? Because you need to make those loans first, but also you need to do the investment through your brokerage account. Whereas working with the index CPTI, that would be through a company that does that for you.
Yeah.
And that would be directly connected to the to your company and you open an account.
Yeah, the company makes a contract with the EPT provider, and it will of course use then, don't have to do anything about it. So it's one-stop shopping, of course. That's easier about the index EPT. The loan, you have to make a loan agreement. You have to make an online, most of you might have an online account already on your personal name, and then do ETFs. Do it yourself, of course, is a little bit more, but in ETFs, do it yourself, Sebastian, is not that difficult.
Mm-hmm. Indeed, especially when it's 1 or 2 ETFs like we like to do. Awesome. Do you have one more slide? I think you had one more slide.
Let's see. Yeah.
Like
So just to wrap it up, this is a work in progress. We've calculated, we've done it seriously. We've gone to an accountant and presented our scenarios. The accountant did not see a problem for the moment with these different scenarios, but again, if you guys want to have more input on this, want to look at your personal situation, you can go at info@vermogensgids.be as a mail address, and we love to hear from you.
Yeah, so Tim Nijsmans and Tim Dierickx.
Yeah, the two Tims.
Yes. So Tim Nijsmans is also a Fire Belgium consultant, so you can book an appointment one-on-one with him as well. So that's something that's possible via the website. For those who are watching the replay or listening to podcast, the links to Tim's email and the links to booking appointments who are going to be provided there, I will put it in the chat a bit later. Certainly, so that's something that you can do. Something else that we are currently discussing, and I guess now is probably a good time to just get a sense of if that's something that would be interested. We still have time for Q&A, but before we do that, one of the current projects that we're discussing is to establish a group of business owners or soon-to-be business owners who want to implement those strategies and basically work together on those, because those scenarios, those challenges are the same for most of us. Index investing is fairly straightforward, but then there's a certain work to be done. And I think if we come together and we work on those together, we can probably, solve each other's problem in a more effective way. We can work on, Tim's model, develop the strategies and the methods to do this, talk to the right accountants and put this together. So I would love to know if you can tell me in the chat if you would be interested in joining a group like this. It might be paid at some point. I don't know exactly. It depends on the value there is. It wouldn't be expensive because it would be a group thing. The idea here is to bring the expertise together, crowdsource, experience from people who are doing this. There might be people who are already hacking the system and have found even more effective ways. We want to hear about that together, but it would have to be in that community, basically your community, our community, where we would bring those people together so that we have this knowledge in place and we can all benefit from it simply by sharing this knowledge. And obviously that would give us access to Tim and his team when you need one-on-one support and maybe some other experts. If that's of interest, then we can put something together to make it easier, basically, for everyone to do this, because it seems so powerful. I think investing as an individual is something a lot of us have already started doing, and optimizing this with our businesses and companies makes a lot of sense. Okay, so I see there's a lot of people already interested in this. Then what we'll do is we'll probably follow up later next week or something with an email with like a first step. I think the next step would be simply a follow-up meeting. And I was discussing this with Tim. It's probably in 3 weeks. I will have to decide exactly what date works. And we might set up something like a WhatsApp group or a Facebook group or some other community style thing where we can just connect and have a communication going. And then from there, it will develop. We'll see how it shapes. But the idea is to solve these problems for everyone, put the knowledge in one place, have a simple step-by-step way for everyone to just come and optimize their finances alongside the rest, and basically optimize finances for your business and investing personally as well. Someone says not Facebook, someone says WhatsApp is fine. We'll see. But this will come with an email for all of you have registered, so you will get the emails that follow the Fire Belgium Money Week. And then from there we can, we'll invite you to join once we have set up the structure. Awesome. Let's do Q&A.
Yeah, hi guys. So I think I saw in the chat there were quite a few questions already around the index-based IPT companies.
Mm-hmm.
I wasn't aware of that either, and so I think a lot of us are really interested to learn which ones they are.
Okay. Okay, I'll say the names, but to be frank, we haven't tested the offering. So we say the names, but we can't guarantee the quality. So it's a bit of disclaimer. Okay. So EasyVest has an index IPT. We noticed, we noticed that it's maybe we interpreted it wrong, but it's not the priority for them. But they have it. And the other firm that we know that have it is Vivium, is an insurer. Vivium also has an IPT with an index investing part. So those are the two names. But I didn't want to say the names up front because we haven't done our due diligence. If it sounds too serious, but you can understand why I want to say that this disclaimer.
Yep, cool, awesome, thanks.
Okay, you're welcome.
Hi, Claudia.
Next,
Hi, Waynes.
Hello, Sebastian. Nice to see you again.
Good to see you too.
After a while, my question is coming. My accountant proposed me to use the services of a company, Probos. What is doing this company? It is selling options from my company to me, the gerant, the administrator. It needs 1 year. There are some fees for the documentations to pay to Probos. But finally, I can take out money related to equivalent to all my gross salary for 1 year out of the company and to pay only, how to say, beneficio natura or a tax that I will pay extra for, like I pay for my. I am not yet really convinced about this because I don't know how the taxation and Minister de Finance will check. It is common. If you know about this, this is my curiosity. What is your experience? It's very fresh. It's like 1 week ago, my accountant sent me this email.
I must say it's a scenario we haven't calculated yet, but I've heard more and more about this. It's pretty, it's new in the sense of for business owners one-on-one. There also have been some option and warrant plans for other companies, for employees usually, and it sounds like a bit of a variation on the theme. But I'm going to be very careful. We haven't studied it yet, so I must for the moment, but I will note it down and I will research it for the future. So it's a nice tip. I will note it down here. So more options for in your own company. Yeah? That's the options of your own company. Okay, good. I noted that, but I can't really for the moment answer it concretely. Sorry.
Awesome. Claudia, any follow-up questions or, I guess you can contact him maybe in a couple of weeks or so.
Yeah, that's fine if you want to do that.
Awesome. I think the next one I saw camera of is Wayne's.
Hi, good evening. I was wondering if there's more information on loaning from the company, since that is the most optimal way of working.
So you're asking how to do it practically, or is that the question?
Yeah, I wonder if there's costs involved and how it would practically work.
Yeah, so it's actually pretty easy in the sense that you have to make a document, but it's just a document between you and the company. So you can make it, you can draw it up yourself. It has to be, of course, a formal document about the loan, the terms, the duration of the loan, and of course, a yield. Okay, I heard 5%, 4%, 5%. And you have to make there has to be a reasonable interest rate. You can't say 0.5% or something like that. 1%, you can't say that. The tax authorities will not accept that. But we heard from our accountant that 4% is acceptable. He said that, not us. But maybe if you use 5%, you're even more sure that it's possible. And then you make the formal document, and you transfer the money to your private account with the you can say loan and a loan with a description about it. And you of course have to keep the documents and pay every year, or if it's a bullet loan at the end. Pay the interest rate to your company. And you can just then, if you transfer the money out, you can just invest it in your personal account in ETFs. So it's not that heavy. It's not that heavy. I must say it's something that some accountants might be wary of. Maybe some conservative accountants will say, "Oh, but it's a bit on the borderline," but it doesn't it isn't something that's frowned upon. It's not something that's frowned upon, but it's something, of course, and now we're doing the optimizing, and we all know that the government and the taxation doesn't like optimizing too much. But for the moment, there is no rule against it. There are no assumptions that are against it. I hope that helps.
Absolutely. Yeah, I was just interested if there's no legal interest rate.
Well, there's no legal interest rate. It has to be a reasonable amount, a reasonable interest rate. And well, usually you have to go above the government rate. The government rate in Belgium 3%. You have to add a percentage or two risk premium. So 4%, 5%. So the government rate plus a risk premium looks very defendable to me.
Thank you very much.
Okay, you're welcome.
I think the next one that raised hand, I'm trying to put people in their order. I think we had this question from Peter, then Christophe, then Thibaut, and then Anne. Let's go in that order, if that's okay.
Okay, thank you very much, both of you, for an interesting talk. I've been, a company holder since last century. So I've been going for a while now. I started with IPT, VAPZ, etc. So I've done that for years. I've switched every now and then because the rates look better. So I'm talking to my accountant. I said, can I just stop or reduce the amount of money? What do you think about that? Because I keep on putting money in, hopefully getting something back in the end. But as I saw your calculations, it's not looking too good. And I know the government cannot be trusted. So in 20 years and 5 years, they can completely change. He also said, if we get the greens in, forget about all the things that we're doing now. But what is in your investment account is safe for the moment. Yeah.
Okay. I'm not sure of the specifics, but usually there's a penalty if you take your money out early in fiscal schemes like IPT, VAPZ. I'm not sure about it. I should check it before I say it. But in a general rule in Belgium, if you take money out of a fiscal optimal situation, like the classical third pillar pension, if you take money out, you get taxed. If you have to give back your tax advantages, you have to give it back to them immediately. So maybe just stopping the new investments would be the more prudent approach. I don't know if somebody else has an opinion about it. They can put in the chat, but I would just stop doing new investments in the classical IPT and the classical VAPZ.
Okay, that's what I also think is best currently. Yeah. Okay, thank you so much.
Oh, you're welcome. You're welcome.
Christophe?
Hi, Sebastian. Good to see you. And hi, Tim.
Hi.
Hello. I had maybe one question and one remark on what Wayne just said just before. Maybe I can have some experience about that. First, my question is about the option with liquidation reserve and the loan. After 6 years, do you convert the loan into a dividend payment so that the loan stops, or you do a loan for 25 years?
No, not a loan for 25 years. So you actually pay back the money, but the company gives you the same amount because it's the liquidation reserve. So it doesn't cost you cash flow. It's just paying back the loan and getting out exactly the same amount. Exactly, except for the interest rate, of course. You get exactly out of it, out of the company, the amount of the original loan. So it's not a loan for 25 years, a loan for 6 years. Yes.
Okay, that might be a detail, but I just want to be sure.
Yeah, it's a good question. And you had a suggestion for Wannes or something like that?
Yeah, it's just a thought because I've been working in the credit department of a Belgian bank for 10 years in the past. And so maybe would that be a solution to make a variable rate loan? Because otherwise you just set a fixed rate in your loan contract, maybe at 4% or 5%. And if rates drops to 2%, then you have to do a new contract. And so you kind of always play with the contract. You could also just say like Belgian government bond yields at the 1st of December of each year, plus 0.50%, for instance. So you make it a variable rate.
Yeah, you can do that. Euribor or government bond plus is something that happens. But of course, you can take the point that if you take the loan out and you click, like the people who took mortgages 4 years ago at 1%, still have 1%. So I think it's defendable to use 4% in a fixed But if you're comfortable with a variable rate, I think that's also possible. Yeah, that's true.
Yeah, that's just another option that just follows the market rates, and you don't need to make a new contract every time something.
Yeah, possible.
That's it.
Okay.
Tim, do you know Christophe? So maybe for background,
No.
Christophe.
No, I don't think so. If I do, I'm sorry. Then if
no, it's
No,
okay.
I don't think
For
we know
everyone
each
who's here, basically Tim is a champion of index investing. He's fighting the big fight with me, and Christophe is too. So Christophe is also helping people invest in index funds. He's doing it in French, and we basically do very similar things, each of us in a different language.
Great.
So Christophe also a big champion of the cause here, also a great source of inspiration and learning for me. And a lot of people are working with him as well and making great progress. So everyone, if you don't know Christophe Dumortier, check out his YouTube channel, Education Finance.
Exactly. Thank you, Sebastian. That's it.
Awesome. And I think on the list now I had Thibaut. Salut Thibaut.
Hey guys, yeah.
Hello.
Thank you very much. Very interesting. I was wondering on the different scenarios you talked about.
Yeah.
If I have a company with a dividend tax of 15%,
yes,
would that scenario become the new best?
You can't go from 15 to 0, I think, if you have already 15%. So that's the best option. Then you can just give a dividend to yourself and start investing with ETFs. And then you don't have to pay yourself an interest rate and be taxed on the interest rate. So yeah, if you have 15%, good for you.
I'm confused. Isn't that most companies? Because everyone that has like a management company can fit those conditions.
Then I must talk to my accountant. I must talk to my accountant if it's easy. But thank you for the tip. I will ask my accountant. It's VV.
Yeah, well now I have a doubt. Like, am I really getting 15%, or did my accountant?
No. I'm not saying you don't. I'm saying probably there are some rules about it. I hope. Otherwise, I haven't paid myself a lot of dividends yet. So maybe it's for the future for me.
Well, that's it. Thank you.
Okay, you're welcome.
Awesome.
Yes, hello.
Hello.
Thank you for the presentation. So I would like to ask about the option you presented regarding the loans. So I don't know about the rest, but for me, like the money is coming in sequentially, which means it's not like there is money today and in the next 6 years, there's no more money coming in, which means if we do a loan today for 50,000 euros, can you do that again next year and next year? Like, can you do 50,000 per year or something like that, or 20,000 per year? Because it's not like today. And by the time you reach year 4, maybe it's not worth it anymore. So that's the question.
Well, it's a good question, because I talked with my colleague Tim de Brijker about it. I said, okay, we have to have a simple case, because if we're starting to go with in year 2, in year 3, it becomes numbers.
Yeah.
But I said, okay, we can do that every year. We can go make a liquidation reserve. Some companies do that every year, make a liquidation reserve, and then you can make also a loan every year. And the loan is not because it's not very difficult. It's just in Dutch they say onderhands document. I don't know what the English translation is. Just a simple document, of course, phrased correctly. But you can make the same. You can use the same document and just make the dates and the rates. So you can change it, and you can do it every year again. Yeah, that's possible, I think. Yeah.
No, I was just wondering legally, because it starts to feel like you're taking free dividends on a yearly basis by paying very low taxes. So
you're still paying the 15%. You're still paying the 10 the 10 and the 5 in the liquidation reserve. You just use it.
Taking them
you use it earlier, and you pay a market rate for it. You have to pay a market rate for that loan. You can't make a loan of 1% or 2%. You still have to pay actually from your own money to the company a real rate. So that's the catch. That's the catch.
But that money, the rate you're paying, stays in the company. So practically, you're not paying for. You would pay for between yourself and the company, and then that would be profit. So you would pay 20% of that, which is like 1% or something like that.
Yeah, you have to pay a tax on the profit in your own company. Yeah, that's the case here. So yeah, I think it's a plan that's very much defendable. And it's if it's not, probably they could make new laws and regulation in the future that prohibits it. But for the moment, we've checked it with an accountant. If people have to, if you all check it with your accountants and they have a real rule against it, and not just I wouldn't do it because I don't feel comfortable with it, let us know if they can cite a rule or a precedent or something like that. But let us know, then we can adapt our plans.
Thank you very much.
Okay, you're welcome.
This is very useful. Thank you so much. Any other questions? Anyone? We still have time.
Yeah, I do have another one. So again, to come back to the IPTs, something that I haven't looked at seriously yet. I haven't looked quite seriously at the loan and the liquidation reserve approach. I have some friends do it in the Netherlands. I think the percentages and the rules are slightly different in Belgium, and it does have a little bit of an effect. And so I haven't really pulled the trigger yet. But the IPT now, especially if there's an index to do it, sounds really interesting. But then it does have a maximum, like a cap on what you can put in, though, right? Like, I understand. So I'm not from Belgium, so I'm here, relatively new, and so I understand. And I think you mentioned your example. There is the back service ability, I guess, to perhaps sort of catch up and put a lump sum in initially. So that might be interesting for me. But then going forward, there's something like an 80% rule, right? Which is effectively tied to your salary.
Yeah. So there is. That's a very good comment. There is a cap to what you can do with EPT. There's a cap to it, so that makes the maybe a combination of the index IPT and the liquidation reserve with maybe a loan in it. It's maybe the combination that's the best way forward. But you have a good point. There's a cap to the IPT scenario.
Yeah, exactly. Because on the one hand, you've sort of been trying to keep my salary as low as possible, because obviously that's, the tax-wise is very expensive. But this sort of, this kind of an incentive to, pay out more salary, because that way you can put in.
The government does everything for a reason. So if they give you something, they expect something, and that's why you get also a lower tax rate if you pay yourself a higher wage, and there's. Yeah, it's all tied together, and maybe in the new government we get even tighter rules. So okay, time for a new webinar after the new government.
Yeah, thanks.
You're welcome.
Tim?
Yes.
Yes, maybe just to make it totally clear for me, the assumptions you took for the liquidation reserve plus loan, because if you inside the company, if you buy the exact same ETF within the company or outside in your own name, why would there be such a difference between a scenario? Because it's the exact same performance, exact same fees. So did you took an assumption that within the company you don't buy that ETF, you buy something else?
We use the inside the company. After 6 years we sell it, but we use a 25% tax rate, because there's a capital gains tax of 25%. That's the difference.
And that's totally avoided in private name.
Yeah. And that's if you keep it in, you could keep it in, but then at the end, 25% of a compounding ETF is a very high tax situation. So if you put it after 6 years in your personal account, for the moment there's no capital gains. Fingers crossed in Belgium, and that's the positive side on that. Yeah.
Okay, got it. Thank you.
Good question. Yeah.
Any other questions? Such a complex topic and only so many questions.
Yeah, I have a question as well. So as a bit of a follow-up. So now that I'm not sure what companies can take as term deposit accounts in terms of interest rate. So what I heard, not sure of the numbers, but first, if you go to a term deposit account, there's no limitation of 50% to be considered. You don't need an LEI number. That's what I understand. That's from one positive standpoint. So you can practically invest all of your equity. From another standpoint, also, I'm not sure. So do you pay the précompte or the 30% on that? But then because it's a company, it's like VAT where you return it. So the actual interest is a net amount, because in that case, it might start to be interesting as well.
Yeah, that's true. So the interest rates from term deposits I'm not 100% sure, but 99% sure that's a profit in the company. So the 30% you pay is indeed, like they say, voorheffing in Dutch. So you pay it in front, but you have to pay corporate tax on it. So you can have the 30% and deduct it from your corporate tax. And then if you like I heard Belfius has 3.9% in 1 month on term deposits. I heard from some of my clients, it's of course an interesting rate in the short run. In the short run, that's an interesting rate.
Yeah. Okay. Thank you.
Yeah, no problem. Somebody else wants to ask a question? Shoot.
Yeah, I'm curious to the spreadsheet behind your example, right? And so I understand like there's a bunch of assumptions you made, and some of these might be tweaked, and some of them might be realistic. But do you have those? Do you have that online? Would you be willing to share that?
Well, let's say we've put a lot of work in it. If you make an appointment with us, we can look at it together. But it's a bit. We put a lot of work in it, so
yeah, that's fair.
Just put them online. I know you can ask. It's not a problem, but we put also a lot of work in it. So
yeah, fair enough.
One more question. Do you have any advice on what to do with the other 50% of the funds available in the company that we can't use to invest?
I think we heard term deposits, and if that's not considered an investment, maybe a term deposit at Belfius 3.9%. I'm making an advertisement for Belfius, it seems, but you can have some term deposits for that 50%, maybe. It's possible. Other things, maybe other people can suggest something in the chat.
Another point that maybe we don't talk about, and I'm not totally sure, but I think a Belgian company to invest money, like on the stock exchange, it needs to like pay a 250 euros tax or something per year. Is that correct?
I think it's a brokerage account setup cost, or
for the brokerage setup cost. Yes.
I don't know if it's a.
No, I'm talking about. I don't exactly know what the name is, but it's like a fee. It's also legal. It's mandatory.
The lei code to get the lei code.
Yeah, I think it is something like that. So you might end up paying, if I understood it well, like 150 to 250 euros a year. So that's not nothing. So if you if you invest 10,000, it's like 2.5% per year.
Is that a yearly cost? Okay.
I'm not sure. Maybe not. So that's why I'm talking about it, because it looks huge to me.
I asked about that, not 100% sure, but the lay number. So some banks or service providers would sell you at 250, but your actual cost is a bit less than 100, and it is yearly. So it would be 90 to 100 euros, which is correct. It's not a small cost. Plus, I know in Bolero, it's not free. So Bolero would charge you 250 euros a year as the brokerage yearly fee on top of their other fee. So unlike personal account where it's free, so you have the 250 plus, let's say 100 for LEI yearly registration. So you're already up to 350 euros a year.
Yeah. So that's really
okay. That's then, and maybe you have to look at DBE is usually for bigger amounts for the 6 year period with the liquidation reserve. We should do the math on that. We should.
And I think the fee at Bolero, some other brokers don't charge that fee, right? It's really Bolero who introduced it, I think, last year, and I don't know if it's there with other brokers.
The most other brokers don't accept companies.
Some do, and I don't think they have this fee. At least I didn't see it in the fee schedule, because I've.
Yeah, I wanted to ask you actually, Sebastian, because even Bolero, it's not easy to find that fee. You need to ask them.
Yeah.
It's not really a lot public. So I didn't know about other brokers, but for Bolero, it's confirmed at 250.
Yeah, and I think it's worth checking with other brokers, because I don't think they charge for this. And I might be wrong, honestly, but when we did the full review of all the fees of all those brokers in Belgium, only Bolero had this.
If you find a cheaper broker, let me know. Send me a mail.
I can tell you which ones.
That does company accounts and is cheaper.
I can tell you which brokers actually accept company accounts right now, because I've got this here. So yes, we have Bolero and we have Keytrade. Well, okay, they're a bit more expensive to investment. Keytrade, Saxo Bank accepts companies. So Saxo Bank, Keytrade, Mexim as well. So I think Saxo Bank for sure is worth checking in terms of like they're pretty good broker generally. So Mexim, I think, has also some good stuff. So Saxo Bank, eTrade, and Mexim are potential options for company accounts as well, in addition to Belgium.
Interesting to know.
So what you're actually saying is that maybe I got it wrong, that there is no tax like for allowing a company to invest on stock exchange.
Well, it's a kind of tax. The Lei code every year is like, yeah, it's a regulation tax then to keep the number, the Lei number actually. Yeah.
So if it's a tax, then every broker will ask you to pay for it.
Yeah, but the 250 euros of Bolero, we were talking about, I think the 250 euros that Bolero adds on top of that.
Yeah, but then, so my point was actually just to say that if you have a small amount, like 5,000, 6,000, even 10,000,
that's a big part. Yeah.
If you have to pay 100 euros just to tax, just to be able to invest, it's already 1% a year, and that's actually big. So maybe for smaller amounts, then like investing in the stock exchange within the company is not the best option, kind of because of that. And I don't know. I know that in my family, we are talking about crowdfunding, like real estate crowdfunding, things like that. And so you avoid that tax. We're not doing it for that reason. But it's actually a good reason also to avoid stock exchange if you have a small amount.
I think that's a good. We will do the math on it and look at it. It's a good suggestion. Yeah.
And Claudia, you had another question?
I was wondering, what is your opinion about investing in real estate as a company?
That's a bit outside my knowledge center. I know a lot about real estate on the stock market. That's where I have some knowledge. But buying real estate as a company physically, that's not my area of expertise. So I'm sorry, but I'm going to have to pass on the question. Can't be expert. That sounds very conceited of me.
You are an expert, just not in that space. That's okay. Yeah, Claudia. So we, see if you can find someone who knows about this. That is a potential guest for a future event. So if you find someone interesting who knows about this and can talk about it in English, we can bring them as well on the events on the podcast. Hi, Dana. How are you?
Hi. Good evening. Fine, thank you. I also have a question. I started my own company in January, so I'm very new at everything, but I started to explore a little bit the idea of investing because I wouldn't want to pay all my money to the government, right?
Yeah.
And then I saw on the slide that you said that VAPZ is private. However, my broker proposed me an option where VAPZ would be paid through my company. Now, I don't have all the details. I couldn't explain why it would be a better option. So I was wondering if you know about it and what's your opinion about this.
I'm going to have to research that because I'm actually my accountant has advised me to do that as well, but I haven't researched it why either. So I must say it's a good question. So I'm going to write it down, and you could also send me a mail, and I can research it, and then we have both the answers.
Okay, thank you. Yeah, the lady said she will discuss it first with my accountant, but she thinks that will be the best option for my specific situation.
So just for context, my understanding with plans like Pillar 2 plans like VAPZ and all the other either insurance products or occupational retirement and funds, etc., that are managed under Pillar 2, because this is a Pillar 2 product. The long-term return of those products of the past 20 years is 0.64% per year. 0.64% per year. But when the stock market does like 8-9% a year during the same period of time. And for Pillar 3, which then that's like the individual pension plans, right, which are outside of companies, and it's for employees that do something extra, which is really, I'll call it really private. The average return is 1% per year over the past 20 years. So that's from 2000 to 2020, I think. Yes. In the same time, the stock market itself, 8% per year. Right. So the difference here is obviously fees, taxes for some reasons, but mostly is because it's actively managed and fairly expensive within. That's what drives just this comparison, right? If those products were really tax advantageous, which is why the accountants are advising us, because you have a tax advantage, but then the performance within is really subpar. It's like you can't compare it with the stock markets. That's the biggest thing. Now, it makes sense in some cases to do those, right? But I think, for example, an index fund IPT then makes sense because then you combine some of the tax advantages with the most performance way of investing long term, which is index investing. But that doesn't exist in VAPZ as far as I understand from Tim's research.
And it comes back to it circles back to the profession of accountant that likes the really calculated money that you can save some taxes, but they don't take into account better or worse investment result because that's not their area of expertise. And that's not what they shine in, and that's not a problem. Everybody has their specialty, their expertise. So that's often the case why they suggest things that are certain and that can be surely deducted. And that's why I think we have to combine those. We have to combine the certainty of tax and the uncertainty of investment results.
You know, Dana, for VAPZ, you could check with EasyVest. I believe they have a product in VAPZ as well, which then would be index-based. Normally, I don't know what's inside. I didn't see, but I've seen.
I'm also checking with my bank. I am with Van Breda. Well, I will get an offer from them as well, so then I can at least compare. But of course, as I say, I don't know anything about all this, so that's the reason I'm here tonight, to try to educate myself a little bit.
The issue is, you know, the products will sound good from like a tax perspective and this and that and those advantages, but the performance inside is just, it won't compare with an index fund long term. It just won't. It doesn't work. It's just, you know, there's not a single bank in Belgium that beats a simple index fund. Not a single one, like on a consistent basis, on even short periods of time, like 10 years, none of them. It's insane. So, you know,
there's sometimes the expression that everything you get as a tax advantage, the bank or the insurance company takes back. So if there's a tax advantage, they use it to sell you a product, but that dilutes the tax advantage to the amount that actually there's for you less in it. So they know they can sell you something because they put tax on the name and tax deduction, and they charge up because they know people will buy it because of the tax reasons. And that's usually the case that banks and insurance usually use the tax advantaged products to enhance their income. They're free to do that. They're free to do that, but we are free to look at it and to be critical about it. And that's what the first step is, this webinar podcast. I think to illuminate everybody on the problems in this case. Yeah.
Definitely very useful, at least for me. As I say, I'm totally new, so it's really useful to hear and to see also your facial expressions here and there.
I see in the chat that Roel has talked to a bank and they came back with a fund that beat the benchmark. Yeah? But that's, of course, if you have 300 different investment funds as a bank, it would be very poor if you can't find one of the 300 that beat the market. But of course, if you said that 15 years ago, which of the 300 will outperform, they will not know it. They can say, okay, let's one of the 300 in one of 100 strategies that miraculously pans out, that we will put as an investment fund example that beats the market. In the rear view mirror, we can all beat the market. In the rear view mirror, we can beat the market, but looking ahead, very difficult. Very difficult.
Maybe if I can pick in. So this particular bank, I think they only have one specific fund. I don't know too much about it, so I just went to a global conversation with them, and I was surprised about this result, what they sent to me. So they only work with one fund, and there are no alterations to it. So you can only change like how much percentage, like to go full equity or so on.
And do they use the same fund the last 20 years?
That's a good question that I can't say, actually.
That sometimes we see that advisors, they switch their offerings and they select, they repackage investment funds that did well in the past, and sometimes they give them the results of the past, insinuating they had this fund for 20 years, but in reality they're just advising it the last 1 or 2 years. And so it could be that there's a good fund in it, but is the fund at that bank already 20 years in their offering? That's a difficult question. We see here.
This is, this is
The evidence-based. Huh?
It's evidence-based, and I have a podcast coming on this that's going to be published in the next couple of weeks. But basically, this is a long presentation, and we look at 5 different reports. So this is just one that is very striking to me. So when you look at the performance of actively managed funds from all banks, right? And this is for European active versus passive barometer. Right? So this is European-based funds by banks. And you look at how they perform compared to the passive equivalent, so the index fund equivalent in this case, right? So including fees of index funds that are passively managed. And you can see that over a 1-year period, right? Over a 1-year period, only 28% of actively managed funds, we're going to come back here, only 28% of actively managed funds sold by banks, right, do better than the equivalent ETF, basically. And in 72% of the cases, the ETF does better. So 72% of actively managed funds fail to do what they're supposed to do within 1 year, right? And this gets worse as time passes because obviously fees and poor performance adds up. And after a 20-year period, right, any kind of 20-year period over the historical data that was used for this study, 88% of actively managed funds underperform, fail to do what they're supposed to do because they do worse than a simple ETF, right? With the same asset allocation, risk allocation, geographical spread, it's all of this, right? All of that is taken into account. And so only 12% of them do better. So obviously for any bank that has, say, 100 funds running for 20 years, they will have about 10, 12% of those that do well and a bit better than the index over this term period. And we can see here that actually over that 20-year period, 72% of those funds actually closed, right? And they closed, why? Because they underperformed, so it's hard to sell them. And they mostly keep selling those that did well compared in the past, right? Compared to any kind of benchmark. So that's why they keep a bit more than just those that did better than the equivalent in index fund. So that's just what they do, right? Banks will close funds that perform poorly. And I mean, Tim, you know that because you were
I worked there. And the trick
in the private bank.
The trick, if they close a fund, is to merge it with a better performing fund. So they take the track record of the better performing fund. They merge the worse, the bad funds, they merge with it, but they say, but we keep the best performing fund as the original fund. And they say, okay, now you have the performance of that one fund. That one fund they have that outperform. They put more and more money in it, but of course the outperformance was in the past. It was in the past, and you get the strange. I sometimes get clients. They say, but if I look at this fund that I have, it's not that bad. But then they say, but it changed name. It changed name. It changed numbers. It changed a different. And then I say, okay, they merged your original fund with a new fund or with a good performing fund, and it's a trick they use to make the track record, to confuse the track record. And that's something I don't really like.
And then at the end, after 20 years, you can say, well, look, we have this one fund that beat the market.
Yep.
Because they started with whatever, 50 or 100 of them. And I've seen other people come to me and say, look, why, Sebastian, should I go with an index fund if this bank shows me that they have this one fund that has done better than they? And I said, go and ask them the results of all their funds that were in existence at the time of like when they show you starting date here, right? And the advisor was like, oh, I don't have this data. It's not available anymore. It's true, we've closed a few funds, but like all of a sudden, no information, But on this one fund, it was all over the place, So it's kind of it's how it works, right? But
let's be honest, Sebastian, I come out of the business, but nobody wants to go to work and say, okay, today I'm going to do a bad job. So
they're not doing it to annoy people, right? It's just...
they're not consciously trying to do a bad job.
No.
And they really try. They really try. It's not that they don't try. It's just the environment is against them. The regulation, the costs,
the business model.
The business model is against them. It's very difficult as a one person to change that. I tried it from within, not possible.
So now we're trying as a group.
Now from the outside.
But Roel, maybe there is only one, and maybe they were very good, right? It's just from our experience.
It's possible, Roel. It's not that it's completely impossible, but it's unlikely. It's unlikely.
Yeah, we don't know about that specific fund and that specific bank, so.
No, thanks for the feedback. It makes sense. I can actually give information. So it was Bank Delen. Bank Delen, I think, has one actively managed fund, but I
Bankdelen. I know Bankdelen really well, and they have about 30 or 40 actively managed funds at the moment.
Perfect. Thanks so much for clarifying that.
Okay, good.
All right, then I think everyone would like you to join me in thanking Tim for his time, his expertise, the effort that he's put into preparing for this presentation, the work that his colleague Tim also did. If you don't mind dropping in the chat, a big thank you, explain maybe in the chat as well, because I'm going to keep a copy of that, what you found useful, what was maybe the most interesting part of this conversation. It's going to be a nice souvenir for Tim to see all his positive feedback. And then
hopefully positive.
Well, we'll see. Maybe some people are like, oh, you guys. And then thank you everyone for joining. The recording of this event will be published on YouTube and on the podcast. Feel free to share. If you want, please connect with us on LinkedIn. We're both quite active on LinkedIn. Join the Financial Independence, the FIRE Belgium Facebook group as well, because that's where we do a lot of this work here. And that's the community I run. All right. Thanks, everyone.
Thank you for your attention.
One more thing, since you reached the end of this episode, and I hope you really enjoyed, then I think that you might be interested in two things. First of all, I do have a free workshop on how to invest in index funds in a simple and effective way, evidence-based, exactly like we discussed in this episode. It's not optimized for business owners, but it works for any individuals. And as you've seen in this episode, one of the most effective ways of investing as a business owner is to simply take the money out of the company and invest it as an individual. So the free workshop is on the website. It's on firebelgium.com/investing workshop. It's free, and I provide my entire roadmap of how to get started, what to look out for, how to build your strategy. And then in this workshop, I invite you to join my program where I actually help people implement, that specific roadmap that I'm sharing there. And the other thing is you can join the FIRE Belgium Facebook group, because I plan on running more events to help business owners invest better. There might be a community that we'll create. We might do some working groups and all these things. So join the Facebook group, sign up to the newsletter, send me an email at hello@firebelgium.com. I hope you enjoyed. Tim has been amazing, and we'll have him on the show again. Thanks again. Take care and see you next time.